What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. The video's coming out late today, so drop me down below in the comments section the keyword if you know it, and as always, anything we are associated with is linked down below in the description. With that being said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got a nasty inverted hammer. The defining characteristic here is, of course, the large upper wick, indicating that the sellers stepped up towards the highs of the weekly range and were able to close prices back down towards the lower third of the weekly range. Now, granted, we do have a green inverted hammer, so that would tell us that we did not violate the opening print for range expansion to the downside, but the give back from the highs was so significant, I would say that the sellers are in control from a structural perspective. If we think about location on the bar-to-bar count, we did produce a higher low as well as a higher high, which, yes, traditionally is a bullish indication, but think about where we've closed, certainly not anywhere close to the highs and actually back down towards the midpoint of the red-bodied bar right here. So to me, it's more of an indication that the buyers absolutely failed to get any price acceptance in the bullish direction above and outside of the prior weekly range. In terms of the June low, we've closed right back down on it, and we're also starting to interact with that weekly 200 SMA once again. Remember that when it comes to moving averages or any technical indicator in general, the first test is the best test. Look at what happened here. Swift move away, that held up. As soon as you start chopping through some of these indicators, it gets exactly that, choppy. So I would no longer carry forward the weekly 200 SMA as a bullish data point. It did provide some sort of bounce. It was short-lived, and now we're right back down on that 200 SMA. That ship has sailed, right? So that is off the table as a bullish data point. Let's take a look at our trend. Here's the all-time high. Lower high, lower high, lower high, and this week's upper wick certainly would constitute, to me, another lower high. Why is this significant? Well, in last week's episode, we talked about the fact that it was pretty difficult to be pulling off a new money short down here at the lows after 3 very aggressive solid red-bodied bars. Now that we've got this lower high in place and a little bit of a consolidation type move, it would be reasonable to look for a breakdown of these lows and get some follow through without it feeling like we are quote-unquote chasing the price action in the downward direction. Let's take a quick look at our volume profile and see what's going on from this perspective. Our 340 high volume node has not moved, obviously. That is the reset, if you will, to the quote-unquote pre-sickness highs. And look at this, right? If we take a look at where this high volume node was, that's exactly where we rejected in the past week's worth of trade. And knowing that the market likes to move from high volume node to high volume node, we rejected this. We are stuck in a low volume node. The next high volume node is here. Would it be reasonable for the market to start heading towards 340? Absolutely makes sense from a weekly structure perspective. Let's take a look at the daily time frame now and start looking for tradable levels and possible ideas into the coming week's worth of trade. Throw on the 50 SMA in blue, 200 SMA in green. First up, of course, is our weekly expected move. What's going on from that perspective? It's a little bit deceiving this week. Last week, the expected move was here. This week, the expected move is right here. Now, you might be saying, okay, higher low and higher high, right? All good, bullish. No, absolutely not. Remember that price is the driver. If we were to make a move to the top of the weekly expected move, it would actually be a lower high underneath the past week's high right around in here, right? So that is a bearish data point. And if we move towards the lows and are contained by the lows, it's still a new lower low underneath the 2022 all-time low, right? So weekly expected move here is no doubt about it in the bear's favor. Now let's start breaking down the wacky price action that we've been getting. Here is a balanced range, and this is really the anchor for anything that we do going forward, if you will. We've already experienced the look below and fail. We've already experienced the look above and fail, and we're right back down in this box of wickedness. I would be very patient in this market until we can get some firm price acceptance underneath 360.75, or not only just above 371, but really above the gap fill area at 372.64. Why do I say that? Well, we know that the gap fill reversal is a very common trade. So if we do move higher, there's the possibility that something like this could happen, and that would produce a lower high on the daily time frame chart, which would be bearish. So to flip bullish in this market environment, we need to go further than just moving above this balance range. We've actually got to get some price acceptance up above that 372.64. So something that does this, fine, we'll give credit where credit is due. That would be bullish. getting some acceptance back within this 3-day balance. But currently, based on the look of this candle right here, I would not chalk that up as a highly probable scenario early on in the upcoming week. One step at a time, please be open to all possibilities. And as we pointed out, anything underneath 360.75 really opens the doors for the bears, especially considering what we were just looking at on the weekly time frame. First up for support underneath us is 355.25, then we've got 352, and then 347.50 is the last downside target that I've got for you, coming from historic levels off to our left. We'll update you if we need to on the Wednesday midweek market update video, but as of right now, I would carry forward a bearish slant, but only when and if we can get some firm price acceptance underneath 360.75. Hopefully I've been very clear that we need price acceptance either underneath here for bearish outcomes or up and over here for bullish outcomes. Anything in between is anybody's guess given the amount of volatility out there in this marketplace. Here's a bearish scenario for you before we take a look at some Fibonacci perspectives. If we get a breakdown early on in the week, a lower high after a dead cat bounce that rejects off of 360.75, that would be a blessing. That would give us some sort of reasonable place to play against with a stop loss just above. Please, Mr. Market, powers that be, give us some trending activity, because this has certainly been a nightmare to trade with lack of follow through from both directions and both sides of the trade. Now, quickly, before we dive into those fibs, let me actually point out that this gap down was primarily driven by the NFP number that came out on the Friday session, and we've got more economic data on the horizon. CPI is coming out on Thursday, and we'll talk about some takeaways of that when we move to the TNX chart in just a moment. So we've got volatility from a headline risk perspective as well this upcoming week. Here are the Fibonacci perspectives that I want to share with you, and then we'll move along through our sectors. Let me make this reasonable to look at. There we go. Taking the fibs out from the FOMC high to the low, I just want to briefly touch on the fact that we got some price acceptance up and over the 61.8, but it was very short-lived, and we've actually closed back down underneath the 38.2 here, which does support more of a bearish thesis. The next Fibonacci perspective is coming in from the rally high down to the low here, and you'll notice that that rejection is right at your 38.2, technically keeping us within bear flag consolidation from this perspective here, which is also bearish and in alignment with what we were talking about on the weekly time frame chart. So overall, I do think that there are more bearish data points that are stacking up here than bullish, but please be patient, be open to all outcomes, and keep in mind this balance area that we've drawn in and hit home in today's video. Let's take a look through some sectors now and see what's going on from that perspective. Anything noteworthy here? Taking a look at the XLK first, this is the tech sector, the heaviest weighted component of them all. This is even more bearish, right? Here is your little balance area, 3 days of balance above. And not only did we move inside of the dominant balance from back here, we actually closed underneath it on Friday. So that does strike me as a bearish takeaway. Tech seems relatively weak compared to what we were just discussing in the SPY itself. I would look for some downside follow through here. Even if we do rally, there's nothing bullish about this until we can get some price acceptance above 125.25. Next up is the XLY for consumer discretionary. What's going on in here? Remember that this has been relatively strong. It's still not on its June lows. So if this is going to play quote unquote catch up, it does seem reasonable given the relative weakness we've seen. The 3-day balance was not above the original balance like it was in the broad market, right? And we're also sitting right back down on these lows. So if this wants to play catch up, it could easily make the move to 133, and that of course would be bearish for your S&P 500. Nothing bullish inside of your XLY until we can get price acceptance above that 149 right here. Next up, you've got the XLU for utilities, lightweight and defensive sector still, but falling off of an absolute cliff. Enough is enough. If you're bullish in the market, you really don't want the defensive sector to get beat up this bad. That's what I meant to say. And you are trying to find a little bit of reprieve here. It's fine. It's off the highs. Like, take it easy. We're all right in the XLU, right? The chart certainly would look bearish to me, but it would be pretty tough to pull off a new money short given the extension we've got to the downside. I just would not be looking for longs inside of utilities. Does not seem like we are coming into any kind of a bottom just yet. XLB for materials, really lightweight sector. We're not going to read into it too much. The one surprising thing here is that we've got a balance area dead on the lows, and there's the possibility that this actually holds up for a higher low. And again, from a structural perspective, things look great, but from a sector weighting perspective, unfortunate that it's the lightest weight sector. Even if it does hold up for a higher low, it's not going to save the day in your S&P 500, so carry that forward. Next up, we've got the XLF for financials. This one's also kind of close to that same look. Here's the balance area. Obviously, we did close underneath it on Friday, but I would say if early on Monday, we can shoot right back up and over that 31, I would give it the benefit of the doubt and say, okay, maybe we're trying to build out a higher low here. I would at least be neutral in the XLF if we can hold up above 31. If obviously we get more price acceptance underneath, that is bearish, and we're looking for a bearish outcome underneath 30.35. Next target underneath is way down below at 29. So financials do get a little bit dicey if we take out the lows here around that 30.35 area. From the daily trend perspective, sure, things are in the bear's court, right? It would seem reasonable that we could move here and see a breakdown. I'm just saying if early on in the week we support at 31, it's at least neutral. I would give it a little bit more of the benefit of the doubt if we can pop up and out early on Monday's session. Next up, we've got the XLC for communications. What's going on over here? This one's pretty tough to look at because the trend is so aggressive. We are more firmly inside of this balance area. So unlike the XLF, I would not give something like this the benefit of the doubt where if we pop out early, it's okay. I would say, not really. We've closed so firmly underneath that 49.20 level that I would look for rotation to the bottom and then possibly a breakdown underneath 48, noting that this has been relatively weak for quite some time. This is obviously a big lower high. Underneath here, rotation into 46.40 does seem like a reasonable outcome for the upcoming week, which of course is bearish pressure. Real estate sector, very similar to utilities. Pretty tough to pull off a new money short in this, but obviously it's not a long. Just because something's not a new money short does not mean that it is a long. This chart is hideous. It does look like it can continue to rotate to the downside, which of course is just not great for people's perception of their own wealth. Next up, we've got the XLV. What's going on in the healthcare sector? Certainly very, very concerning, right? Obviously on the hourly or 4-hour time frame chart, this was looking like a double bottom. Your neckline was here at 124. We've clearly failed firmly back down underneath that level. We're also not holding up above that 125. I was ready to say, okay, fine, things are shaping up a little bit here on Tuesday, Wednesday, Thursday, but Friday, big nail in the coffin, if you will, to send us back lower. Instead, I would start thinking, okay, highs, lower highs, lower highs, very likely that we produce at least an equal low, if not lower low, to continue this trend to the downside, which is very concerning, remembering that this is ultimately the second heaviest weighted component of your S&P 500. So XLV, keep a very close eye on it. Anything that just remains underneath 124 at this point in time does strike me as bearish, right? We've looked back above that 125. We tried to get some price acceptance above that monthly balance low, and it's just not happening. So anything that really just remains here under 124, again, does strike me as a bearish outcome, even if we're not aggressively breaking down underneath the lows, just based on the failure from the buyers up and over that 125. Second heaviest weighted component, certainly worth keeping an eye on. Next up, we've got the XLP for consumer staples. What's going on over here? Certainly breakdown, lower high, new low. I would look for this to continue either lower or produce another lower high, but this time around underneath 67.28 is the ideal location. If we're going to flip bullish on this one, it's got to be price acceptance above 68.90, which does not seem likely given the situation of Friday's close down here. Next up is the energy sector, the only place where there's some relative strength. We'll see that on the ratio grid in just a moment, but remember, this is D for defensive. We don't want it moving to the upside. If the market's trying to find a bottom here, we want it going sideways and lagging the market. So overall, this does strike me as concerning. It's supporting the idea that we are not in a risk-on environment, which we'll talk more about on the ratio grid in just a moment. If we do see a pullback, ideally bulls want to see 78.50 hold. If we fail that, okay, steps in the right direction. We want to see this thing cool off a little bit and go sideways, not aggressively make a move towards those all-time highs up there. Last but certainly not least, we've got the XLI looking much closer to the materials sector from a structural perspective, right? You can see that there's the possibility of this balance range producing a higher low off of the top end at 85. If we hold up, great, but remember, this, just like materials, is a fairly lightweight sector. This is a little bit heavier. It's 7% of the S&P 500, but it's not really enough to move the needle if your XLK is bearish, if your XLF is bearish, if your XLV is bearish as well, which we pointed out in almost all of those charts that the bears do seem to have the upper hand. So not really all that convincing here in the XLI. I would just continue to watch your 85 handle right here. Next up, we've got our ratio grid. If you don't know what this is or how to set it up, check out this video in the top right-hand corner, and let's get down to business. The top four are the risk-on sectors, and what I would continue to point out is that the XLK continues to struggle. It is underneath a descending 50 SMA. That's the gold line here, and that does strike me as a bearish look for our SPY as a whole. The XLV continues to chug to the upside, but that's not really all that convincing when we sort of know what we know about the structural chart, right? So not really this doesn't hold a candle, no pun intended, next to what we see here. The XLY is rolling over, which makes sense. It's losing its relative strength, and the XLF is actually doing quite fine on a relative basis, and the chart does strike me as being more healthy than the XLV. So I'll give that one the benefit of the doubt here, but overall, the XLK is keeping us in more of a risk-off environment. Next up, the bottom four are the risk-off sectors. What you'll notice is that the XLP is going sideways and kind of fine down here at the lows. Real estate is concerningly low, and we talked about the wealth effect in previous videos. Energy, obviously indicating screaming really, hey, risk off, don't do anything too aggressive, right? You look at that trend here. It's really, really aggressive. And utilities is the exact opposite, kind of falling off of a cliff, and we know that from the chart as well. So overall, if this is pointing and screaming to the upside, and this is not pointing to the upside and screaming to the upside, we are not in a risk-on environment in our marketplace, which should be, I don't want to say fairly evident, but as the market's kind of falling apart here, it'd be pretty big stretch of the imagination to say that we're bullish across the board. Next up is the TNX. What's going on from a rates perspective? The general relationship, as we know, is that as rates move higher, the market generally moves lower because tech does not like a higher rate environment. Tech is the heaviest weighted component of the S&P 500. Therefore, higher rates, lower market. This does appear to be, from a technical perspective, breaking out of a bull flag. So can we see higher rates? Absolutely. Remember that on Friday, the NFP number basically was the nail in the coffin to confirm another 75 basis point rate hike. The Fed has really been transparent about watching the jobs market closely. The jobs market was fine based on Friday's jobs report numbers. Therefore, the Fed's going to continue to be aggressive and give us the 75 basis point rate hike. With CPI on Thursday, this is where things get kind of dicey. Let's go over to the Fed tracker tool actually and take a quick peek. So here is what we've got on tap for November. Again, the market is basically pricing in a 75 basis point rate hike. We're at 300 to 325. We're headed towards 375 to 400. That, of course, is your 75 basis point rate hike. If we look at December, though, what you'll notice is that the market's pricing in a 50 basis point rate hike. So if CPI comes in hotter than expected, if inflation continues to get out of control, I would imagine that this quickly shifts over to this column and the market's in store for another 75 basis point rate hike, which I would imagine the market does not like very much and continues to move to the downside. So just be mindful of that on Thursday. We're not betting ahead of the number. We're just reacting to it accordingly. And we'll, of course, cover that live on the pre-market live stream on Thursday morning. So back on over to the platform, let's take a look through some volatility instruments now. The VIX is up first. All I would point out about this is that the VIX is still elevated, although we did see some positive price action on Tuesday, Wednesday, and even Thursday with that consolidation. Look at what's going on here. We dribbled a little bit lower, but certainly not out of the woods. And on Friday, we're right back up in the bulk, I would say, of this box overhead. So volatility is certainly still out there in the marketplace. All this would tell us is that we are more prone to downside moves as VIX remains elevated well above that 2050 area. If we're going to see a capitulation type bottom, just keep this in mind, right? We were talking about the move to SPY 340. If the VIX spikes up towards 40, I would imagine that we get there quite quickly to that quote unquote reset in your S&P 500. Just something to think about. Next up is going to be the VVIX, which is the volatility of the volatility index. And some people are starting to recognize the risks in the marketplace, and there's starting to become some hedging on the Friday activity when we fell back down underneath the weekly expected move. Dynamic hedging takes place, the whole 9 yards. And people are basically buying SPY puts and VIX calls. So this should protect us slightly from the flood effect when everybody rushes into those SPY puts at the same time. That's generally when you get a move that spirals out of control in the overall market based on gamma hedging, right? Or gamma hedging. Yes, gamma hedging, delta hedging. Basically, market makers want to be delta neutral, right? They do not want to be net positive or net negative. They want to be neutral. Therefore, when everybody rushes to buy SPY puts, let's just walk through it so I can clarify in my own head, right? When everybody buys and rushes into SPY puts, market makers sell those SPY puts. Therefore, they are net negative delta. What do they have, or net positive delta, because they are net short the puts. They have to go out and they have to sell ES, they have to go out and they have to sell the SPY, right, to neutralize their delta and get back to even, causing more selling pressure in the market. If you already knew that, then fantastic, but I had to walk through it for the sake of my own sanity, and maybe you did learn something new. Anyways, let's take a look at the /VX. Oops, we want to put a X in there, /VX for our volatility futures. Here we go. My brain's moving at 1,000,000 miles an hour. Can you tell? Here we go. We are looking at the October contract right here, 32.05, and the November contract right here, 31.65. We popped out of backwardation or inversion, whatever you'd prefer to say, on the Tuesday and Wednesday sessions, but promptly fell back in on the Friday move there. So this is just indicating to us right now that there's more risk today in the present day than there is out in time, which is obviously not a good thing. It just is an indication that, hey, the market's recognizing that there's plenty of volatility right at this point in time. So be prepared for large upside and downside swings, which is why we're being open to all possibilities in the marketplace, not just married to the downside, although the charts would sort of give us an edge in the bearish direction. Anyways, that has been a look at volatility. Hopefully I didn't lose anyone in the weeds there. Let's take a look at our market internals now. This is pretty important. I got the argument from multiple people on Friday that, hey, look at the SPY volume on Friday. This is really concerning. And yes, I would agree with you to some extent that, on a big sell side day, big gap down day, we didn't see a big spike in volume like we typically do on panic days. However, take a look at your market internals. Does Friday support outflows in the market? Absolutely. We were well underneath that negative 300 million mark. So don't be fooled by the SPY across the entire broad market. Yes, there was plenty of outflow across the entire marketplace. The advanced decline line continues to indicate volatility with these massive degrees of overcorrelation. At first, it's buy everything, buy everything, buy everything. Then it's sell everything, sell everything, sell everything. If there's no market rotation going on, it will not keep a trend alive. So ideally, if we can break the daily balance area in the SPY and get something that in the advanced decline line looks reasonable, contained within negative 1,500 or positive 1,500. I know I did that backwards, but you get the gist. Something that's contained and reasonable. Maybe we can start a new trend in the marketplace. But if you continue to see these really aggressive overbought and oversold reads back to back, very, very difficult to produce a trend in the market, just an indication of volatility. Tick's not really telling us a whole lot. I guess you could confirm that Friday's breakdown was real, given the nature of moving underneath negative 5,000 towards the close of business there. Let's take a quick look at our market profile and see what's going on from this perspective. All I would point out here is that we've got a little bit of a spike on Friday's session that I want you to be aware of. So obviously we talked about the gap overhead. That gap may start to fill more aggressively sooner than you think, just based on this spike from Friday's session, right? So if we can move above 36.95.50, we'll call it, that would be the preliminary level where I would say, okay, maybe there's the possibility we get into that gap overhead before we actually take out Friday's high, right? So this is a market profile, quote unquote, inside secret, if you will, to be prepared for that level. Notice that there's not really a whole lot of volume in there. If we breach that 36.95.50, that might be your advanced heads up that, hey, we're possibly looking for the gap fill on Monday, Tuesday, or whenever we start to get above that level. That's a main takeaway from Friday's session. Other than that, we've got the low is fine. Technically, there is some excess down on that low. You can see we've got 3 TPOs down there. Looks like the market is currently open, obviously, and we're dribbling down underneath for a small gap down, but a lot can change between now and 9:30, so I wouldn't read into that too much. Another thing that I would point out very briefly before we continue back to the platform is that we've got a double distribution from Friday as well. So an area of resistance you might want to pay attention to is 36.68.50, 36.68.50. If we rally and produce a lower high off of that, then just know in the back of your head, hey, the double distribution is working. We're getting acceptance in the lower distribution from Friday. That is, of course, bearish, and you should start looking out for short opportunities in the marketplace. If we don't reject there and we just hang out, then again, it's all eyes on that next one overhead at 36.95.50 for the string of single prints above us from the early morning breakdown on Friday. That is the gist of the market profile. Let's get back on over to our platform and round out the broad market. The psychology aspect will be very similar across the QQQ and IWM as well. So we're not going to dwell on that. We'll just get down and dirty with the numbers. Here is the balance area. You can see kind of a failure overhead here. We've closed underneath on Friday's session. So this is obviously more similar to that XLK, right? That does strike me as a more bearish look. Any breakdown of this set of lows right here around 267.50 opens the door for lower. Our next downside level is 261.25. Lower edge of the weekly expected move at 258. And then 256.50 is also hanging out down there as well as a downside level. If we rotate higher, I would be mindful mindful that there can be a lower high produced off of 272.65. And if we move above that, okay, then fine. The gap is in play, but it's certainly not bullish. Look at the difference here. Obviously, to get bullish, we would want to see acceptance above 279.50, which ultimately is just the top of this balance area. So even if we fill the gap, that isn't really that bullish. We can produce a lower high off of the gap fill reversal, right? So things to be mindful of in your QQQ. I would say if we get a bounce, preliminary or primary focus, should be 272.65. And if we get a flush, start looking for targets at 261.25. Next up is the IWM Russell 2000 and the small caps. What's going on in small cap land? You can see that this chart is slightly more bullish than what we discussed in the SPY as well as the Qs. So slight differences in psychology. There's really not an overhead gap from that Friday session. Very, very minor, if any at all. Instead, I would say that this is the most prone to the easier short trade to pull off just based on the look above and fail. Early price acceptance underneath the 169.20, that triggers that, right? And you're looking for that rotation towards the lows here at 163.75. So watch your IWM to be an early indication underneath 169.20. If we hold up here for support, so think of what we discussed in, the XLF. If we can get a quick snappy move above on Friday's session, Monday's early morning session, all over the place. It's late at night, you know the deal. If we can get a move above that early on Monday, that would strike me as a possible higher low. And I would look to be a little bit more neutral across the broad market if IWM starts hanging out here instead of experiencing the look above and fail and moving closer to that 163.75. Just to give you the numbers, 169.20, 171.85. If we can accept above that, that's where things start to get a little bit more bullish in the IWM, looking for a move higher. That's going to wrap up the broad market. Let's get into these companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that being said, we'll dive right into Apple. You can clearly see here that we're getting into and closer to these lows. If they break down, I'm showing you where this target is coming from in here at 134.50. That would be the bearish trade early on in the upcoming week. And I would also start to consider that we can get some bearish outcomes if we rally first and put in a lower high. Anything underneath 143.40 strikes me as an ideal place to get short with a stop just above. If we blast right up through that level, you're looking for the gap fill reversal off of 145.15 for a rollover there. Any price acceptance above that, just like what we've been talking about in the broad market, that would strike me as the only time to get bullish. When and if that happens, we can reevaluate. The next major overhead target would be 148.75. But until that happens, look for the lower highs or just look for neutral in here and ultimately a breakdown of that 138.25. Next up is going to be Netflix finally giving up its relative strength, or at least balance, that it was trying to display here towards the top of the overall range. Remember, we were stuck in this tight area of compression, finally breaking down on Friday. That does strike me as bearish. A lot of people looking for that 250 gap fill overhead are being disappointed. Hopefully nobody positioned early. Remember, we've been harping on the fact that it's 80 points, guys, 80 points. Please be patient. You don't need to be the first one in the door. Let that thing resolve before we start looking for longs. But anyways, with the failure on Friday, we've already doubled the range, so I would not be looking for a new short just yet. I would watch for either some sort of reaction off of these lows at 221.50 and then a breakdown to get into 216 and possibly breaking that is the juicier short trade. You can clearly see the better range available through here to get into 204.25. So I would be mindful of that in Netflix, that ideally we do a little sideways two-step and then break down for the better range over time. But the failure of this range to hold up at the highs does strike me as a more bearish than bullish takeaway. Let's continue along and look at Tesla. Oh, and by the way, let me just address on Netflix. Sorry. We'll rewind. Any rally first that puts in a lower high off of 234, that again is an ideal place to be looking for a lower high on the daily time frame. New money short off of that with a stop just above, looking to retarget the lows in here. So that is a valid setup that I could consider as reasonable into the upcoming week's worth of trade. Next up is going to be Tesla. What's going on with Tesla? Again, breaking down into the Friday session there. So we had a 2-day balance. We broke down. Another 2-day balance. We broke down. It would be reasonable to me to expect a little bit more consolidation here inside of Tesla. So I wouldn't be pushing it for new money shorts in Tesla per se. 219. So if we do continue lower earlier, I would start to look for intraday reversals off of 219. Obviously, you're not overstaying your welcome. You're not looking for a reversal back up to 310. But I would say anything that intraday bounces off of 219, you could look for a little bit of an oversold oversold bounce and maybe ride that, if you're lucky, into 232.25 overall. Just not looking for aggressive new money shorts, possibly looking for a buy reaction off of that 219. Anything that does make the rotation back to here, if you're looking for shorts, that would be the ideal place for a lower high to be formed, right? That's the breakdown from the 2-day balance of Wednesday and Thursday. So that number is 232.25. Next up, we've got Google. What's going on in Google? Taking a look over here, again, failing the 3-day balance to hold up at the highs. That does strike me as more bearish than bullish. If we can get a breakdown of this level right here at 98.75, that's where we're looking for the shorts to rotate back down to the lows here at 96.25. If we hold up, there's the possibility that we get the higher low, but I would not be bullish until we can take out the gap close area at $100.50. It would really require a higher low above to then start looking for that move into 103. So Google might be a little bit of a patience play, but ideally looking for the breakdown here first, or higher lows above 150 cents to start getting bullish. Next up is going to be Meta. What's going on with Zuckerberg and the metaverse finally starting to break down from this balance. This does strike me as interesting. We've been consolidating for long enough. A breakdown here starting can release some serious energy. Think back to your physics class. Plenty of potential energy stored in this box. It's got to release. It's got to go somewhere. If we're thinking about range rules, we typically look for a doubling of the range. That easily takes us into that 128.75 target, if not slightly underneath. The next target after that is going to be at 123.85. Could we get there all in one fell swoop? It's possible, but do be mindful of the 128.75 level to possibly provide some support, or at least an intraday bounce. You wouldn't want to be shorting at that level unless we've put in some period of consolidation for a bear flag and then another breakdown does occur. If we pop back above 134, technically what do we have? Yes, it would be frustrating, but it's just the nature of the market. It would be a look below and fail. We can target the top of the range here at 141.65. Remember, volatility is still rocking out there in the marketplace. Be open to all possibilities. Next up is NVIDIA. What's going on in NVIDIA? Let's zoom in on this thing. I'm all over the place with the tools today. It is late. Drop me that keyword if you haven't already down below in the comment section. If you don't know it, the keyword is night owl. I'm sure you could have figured that out by just taking a look down there. But anyways, NVIDIA, large overhead gap, failing and moving straight through this balance range. It does strike me as more bearish than bullish. Looking for the rotation into 117.25, possibly after that 114.20. If we do rally, looking for lower highs to ideally be very, very near term at 125.50, right? As long as the lower high is underneath that, bears clearly in control. If the rally is more aggressive and maybe over the course of 2 or 3 days we get to here, I would watch out for any indications of a short signal. Could just be a simple inverted hammer, short under the low, and start to retarget the equal low in here. That also strikes me as a reasonable possibility. The only bullish trade I would consider would be looking for the gap to fill overhead. If the market is rocking to the upside and we start to see something that looks like this, possibly the pullback on an intraday, probably not going to want to watch for that on the daily time frame, but intraday, something that looks like that, certainly a reasonable trade to start looking for that 131 target for the gap fill if the market is moving higher in conjunction as well, right? That's NVIDIA. Next up, we've got Microsoft. What's going on in Softy? Zooming in here. What an absolutely ugly chart just based on what's going on with this complete island reversal. I don't know if people call it an island, an abandoned baby. I've heard all types of things about this pattern, but regardless, you've got trapped longs up at the highs, massive gap down, opening right at the top of balance and failing aggressively straight through the area, right? So these people, any trapped longs, if they're not out already, then geez, goodness, I don't know what they're doing. They probably have stops underneath here. They were looking at this as much more of a swing trade. If we continue lower, all of those longs should be stopped out if they're reasonable. And then we're looking for that rotation further into 226. And after that, you can see there's even more range to travel down towards 216.50. So Microsoft can get ugly to the downside based on there not being a whole lot of support off to our left here. Also, with the island reversal with these trapped longs, I would say that the bears certainly have the upper hand on a chart that looks like this. Any consolidation, easy bear flag plays to the downside, certainly reasonable. If we continue lower, watch for any lower highs underneath 235.10 to get on board the train to the downside and start targeting that 226. If we rotate above 235.10, remember, just like inside of Meta, I believe it was, that can constitute a look below and fail. Be open to all possibilities. Maybe even if you don't want to long it, just be neutral in here. Don't be looking to stab short aggressively if we rotate back up into this range. Next up is Amazon. Last but not least, the mini beast. Let's zoom in with the proper tool this time and take a look at what we're dealing with. Certainly the 3-day balance failing back down into the range does strike me as bearish. Because we're in the range and we're not sitting on the lows, I would be neutral until we can get the breakdown of 112.50 or acceptance back above 119.70. I wouldn't really want to get caught chopped around in here. So longs, if we get acceptance there for a breakout into 125.50, seems like a stretch given Friday's activities. And then also on the short side, patience, wait for the breakdown of 112.50, and your possible downside target is coming from in here. The intraday pivot was at 108, and then underneath that we've got 103.65, one step at a time, but neutral until proven otherwise with those two levels we've just discussed. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about, and let's get right down to business in our 4 trade ideas. First one is on ticker symbol ABT for Abbott Laboratories. We are certainly looking at a short trade here, failure and rejection at the 50 SMA. Remember, first test, best test, that certainly looks reasonable to me, and also a failure to accept outside of this breakout range from here, closing underneath the Thursday bar as well. Looking for shorts underneath $100.57 to rotate back down towards 97.80. Short trade idea here inside of Abbott. Ideally, looking for an intraday setup that gives us better risk reward to short that with a stop over the highs and then target ultimately that breakdown level closer to 98. Next up is going to be Enphase, the solar company here. What's going on? Certainly looks like a clean bear flag to me with multiple rejections of the breakdown level at 272.34. Think of all of this as overhead supply, rejected on Thursday, rejected on Friday on those attempts to move higher. Both of them did close weak, looking for a breakdown of 250 to rotate here, 235.23, and then ultimately closing the gap at 221.39. Ideally, a stop loss can go somewhere intraday after the breakdown, so it's tight, but if you've got more of a swing perspective, you could put it over the top, but your target would have to be much more aggressive, much closer to these lows around 180 to make the risk reward worth it, unless you can adjust a break even kind of on an ASAP basis. Dollar Tree, what's going on over here? This was a long trade last week based on these two back-to-back hammers, and it's a long trade once again this upcoming week. Look at what we've got. We've got pure price acceptance up at the highs even when the broad market is falling apart and moving back down towards the lows. So looking at this as a bit of a bull flag, if we can take out Friday's high, and notice that Friday's low also looked underneath the 3-day balance, and we closed firmly back at the highs. Let me zoom in on this a little bit better to indicate just how nice that is, right? From a psychology perspective, remember, we breached all of these lows in that lower wick to snap back up and close towards these highs. Looks like a failure from the sellers to really materialize underneath this 3-day balance, and instead we're looking for the long side now. Breaking out up and over 142.64 ideally gets us closer to this intraday level from here at 151.82. That's also, 28. That's also your 200 SMA and 50 SMA overhead. Risk reward seems reasonable, long over the highs, target up here, stop somewhere underneath an intraday pattern that forms Monday, Tuesday, Wednesday. Next up, we've got WYNN Resorts. What's going on here? This is a bullish trade idea as well. Too short, too long. And what you'll notice is that we've got a little resting bar up at the top of this overall breakout, respecting the 200 SMA. As long as we're above 71.70, we have on the table a breakout up and over 74.25 to rotate into this prior high here at 79, roughly. We'll round up for nice, easy math. That is your upside trade. Not interested if we fail to hold up above that 71.70 level, and then in that case, we would probably expect it to dribble around and go sideways possibly. Anyways, long trade ideally does something like this into the future for an upside move. That's going to wrap up this week's episode of the Weekly Watch List. If you enjoyed the video or learned anything new today, let me know down below in the comment section or by giving the video a simple thumbs up. With that all being said, I wish you a green trading week.